Compound interest is something that many people have spoken about for years and highlighted its importance. For example, Einstein, who called it the eighth wonder of the world, with those who understand it, earn it, and those who don't understand it, end up paying it. And Warren Buffett, who talked about the importance of taking advantage of compound interest to grow your wealth and not become too caught up in the emotions of markets, which I have talked about in quite a few of my videos previously. And finally, just to mention a few here, Charlie Munger, who passed away in November 2023, who again spoke about the importance of understanding the power of compound interest, but also about the difficulty in actually getting it. So in this video, we'll be looking at the huge power of compound interest that many financial giants like hedge funds, successful investors, etc., look to take advantage of. And we'll be looking at what it is, looking at examples of it, and how it relates to crypto. So please do like this video and subscribe to the channel so I can continue to offer more content for you in future. Just a quick reminder, you can contact me if you're looking for crypto coaching. You can sign up for a free account with Coinly using the link in the description to this video, which is one of the best automated crypto tax platforms out there. If you're looking for more specific tax advice based on your personal circumstances, I've partnered with a leading crypto tax company in Miner, and I'll leave a link to contact them directly in the description to this video. And finally, I've included a link to Trezor's website in the description for anyone looking for one of the best hardware wallets or cold storage out there, with two new models released recently in the Trezor Safe 3 and Trezor Safe 5. Just a reminder that nothing contained here is financial advice, and let's jump straight in and look at the power of compound interest on your investments. Firstly, what is compound interest? Well, compound interest is a financial mechanism where the interest earned on an investment is reinvested, allowing it to earn additional interest. And this is the key, because you put the interest earned back into the investment to grow it even further. Because over time, this creates a snowball effect where the growth becomes exponential and you're essentially earning interest on the interest you previously earned. And that's the key difference between simple and compound interest, in that with compound interest, you're earning interest on both the original investment or the principal and the interest that's already been added. And you can see a definition of compound interest here from Investopedia. But let's take a look at some examples of compound interest, because one of the oldest examples is adding grains of wheat to a 64 square chessboard. So the idea is that on the first square, you add 1 grain of wheat, and on the second square, you add 2 grains of wheat. On the third square, you add 4 grains of wheat, and you basically keep doubling the number of grains of wheat you add to each square from there. And how many grains of wheat would you have by the end of the 64 squares is the question. Well, that's 18.4 quintillion grains of wheat piled up on that last square of the chessboard. And I've added that number here on the screen just because it is so large. And some people then simply change the idea of a grain of wheat to fiat currency. So let's look at that as a second example and how much you'd earn after, let's say, 1 month or 31 days rather than 64 squares on a chessboard. Because if someone offered you £1 million, dollars, euros, etc. now, or they offered you only 1p or 1 cent that would double every day for a month, which would you take? Because this highlights the power of compounding and compound interest, as 1p or cent doubled every day for 1 month or 30 days actually ends up at over 5.3 million pounds, dollars, euros, etc., as you can see here. And after 31 days, this ends up at over 10.7 million pounds, dollars, or euros, significantly higher than the offer of 1 million on day one. And this graph shows that quite well in terms of the compound interest effect, especially when you look at the right-hand side of the graph. Obviously, these are examples where you'd be doubling your money every day, which isn't very realistic at a 100% return. But if we look at some of the most successful investors, such as Jim Simons, for example, who was the founder of the hedge fund Renaissance Technologies, and who unfortunately passed away in May 2024, he achieved astonishing returns in one of his funds that you can see here. So if someone had invested just $100 into this fund back in 1988 and kept reinvesting their interest and returns, this would have been worth over $2.1 million by 2018, which included a 5% fixed fee and a 44% performance fee after 2002, by the way. But coming back to our compound interest example, you're also unlikely to start off with just 1p or 1 cent. So finally, let's take a look at an example of compound interest if you had more to invest initially, but received lower returns. Because let's say you had $10,000 or $100,000 or pounds or euros or whatever to invest, and decided to reinvest all of the interest earned back into the investment. And let's say you earned 10% interest on that. Well, you can see here the result of compounding that interest annually over 10 years at an interest rate of 10%, which would turn an initial 10,000 investment into nearly 26,000 or 100,000 into nearly 260,000 over a 10-year period. So to summarize, the difference between simple and compound interest lies in the reinvestment of earnings. With simple interest, in the example we've just seen, you'd only earn 10% of your initial investment over 10 years. So 10% of 10,000 or 100,000, which is 1,000 or 10,000 per year. However, with compound interest, in year 10, you're not still just earning 1,000 or 10,000 in that year. You're earning over 25,000 or 259,000. So your earnings increase exponentially. And finally, it's worth considering how long it would take you to double your initial investment. Because you'd think that earning 10% per year would take you 10 years to reach 100% and therefore double your money. But it doesn't, due to the power of compound interest. You can see here that it would take 7.3 years, not 10 years, at an interest rate of 10% to double your money. It would take 3.8 years if you earned 20% interest, rather than 5 years, and it would only take you 1.7 years to double your money if you were able to achieve 50% interest, rather than 2 years. The advantages of compound interest are therefore exponential growth, as we've seen already in this video, in that the interest earned on the principal also starts to earn interest, resulting in faster and larger returns over time. Secondly, this could be seen as passive income in the sense that once your initial investment is made, compound interest can generate returns without requiring ongoing significant contributions or effort. And an example of that in crypto would be an AMM or multi-chain yield optimizer, like Beefy Finance, for example. And finally, compound interest encourages more of a long-term investment strategy because the longer you leave your money to compound, the more significant your returns will be. However, there are some risks to compound interest. For example, market volatility can affect the value of your investment, especially in riskier markets like crypto. So a longer-term investment strategy is certainly needed to see the full effects of compound interest. Secondly, you should check the fees of financial products that offer compound interest carefully, because these can eat into your returns and lower the effect of compound interest. And finally, inflation is a risk to compound interest and your returns, because if the rate of inflation outpaces the interest rate that you receive, the real value of your returns diminish over time. But how can you actually use compound interest in crypto? Well, you can see this in DeFi or decentralized finance through staking, liquidity providing, and yield farming, where you'll reinvest your yield to compound your gains and returns. Some DeFi platforms will compound rewards more frequently than traditional financial institutions like banks, even daily or hourly, depending on the specific protocol. Other advantages of using crypto to compound your returns are the higher interest rates that you can achieve compared to traditional financial institutions, particularly in a bull market. Secondly, you're more likely to be using a decentralized blockchain, which gives you much greater control over your funds and the use of smart contracts negates the need to use intermediaries or third parties to manage your funds. However, with smart contracts, as we know, there can be vulnerabilities, exploits, and hacks, which could lead to investors losing their cryptocurrencies. Market volatility that I mentioned previously in the general risks of compound interest would obviously apply with crypto also. Some platforms in crypto do require you to lock it up for a certain period of time when staking it, etc., which means that you'd have less access to liquidity, and which could be a disadvantage to you if you needed it, especially if the crypto market dips considerably, for example. And finally, crypto regulation is still developing around the world, and there's still a lot of uncertainty surrounding this, which you'll want to keep up with if you're in crypto. But that ends this video looking at compound interest. And as always, I'd love to know what you think in the comments below about it. If you're interested in more of a tailored approach to your crypto education, and you think you'd benefit from having someone look over your shoulder and guide you on your journey, I do offer one-to-one coaching to those who have the desire and the means to educate themselves further. And there are links in the description where you can message me and book in a free video call to see if we'd be a good fit. There are also links to Coinly, Trezor, and to contact Miner in the description of the video also, as I mentioned at the start of the video. And if you found this content interesting, please do like the video and subscribe to the channel, as it really does help. And have a great day.